Today, we're not just dusting off a piece of financial history. We are conducting an urgent, high-stakes autopsy on leadership blind spots. We're going to examine the absolute fastest collapse in financial history, the 72-hour death of Bear Stearns, and we'll decode exactly how an 85-year-old titan of Wall Street just evaporated over a single weekend. Honestly, if you lead people, if you manage risk, or if you steer any kind of organization, the structural failures and personal disconnects we're about to uncover are absolutely vital.
Okay, let's dive into this. I want you to imagine watching a stock ticker tracking an entire empire. Monday morning, Bear Stearns is sitting strong at $60 a share, right? I mean, these guys survived the Great Depression, World War II, the dot-com bust. They've seen it all. But then the numbers start plummeting. $60, $50, $30, $10. And by the time the dust settles on Sunday evening, $2. It was an incomprehensible ticking clock plunge that completely wiped out a $20 billion market cap in a matter of days.
And do you know what the craziest part is? While this massive financial empire was actively burning to the ground, where was the man at the top? He was playing cards. Jimmy Cayne, the chairman and former CEO, was literally playing in a bridge tournament down in Nashville. He didn't jump on a plane back to New York. He didn't even call an emergency meeting. This shocking detachment is the core leadership failure we're going to investigate today. How does leadership become so entirely blind to the reality of their own ruin?
Part 1. The Cult of Bear. Culture and Risk.
So, they were known as the Bear for a reason. They were absolutely merciless. While rivals like Goldman Sachs and Morgan Stanley were out there recruiting these polished Ivy League graduates, Bear Stearns actively sought out what they called street fighters. We're talking kids from Queens, from Brooklyn. The culture was intensely eat what you kill. You either survived on your own raw aggression or you were out the door. Now, this brutal environment is exactly what made them the fifth largest investment bank in America, but it also fostered a really dangerous ecosystem, one that heavily rewarded aggressive short-term wins and completely ignored long-term stability. Right at the top of this cutthroat culture was Jimmy Cayne. He started as a stockbroker back in 1969 and basically fought his way to the CEO role by 1993. Cayne was a world-class bridge champion, and he treated Wall Street exactly the same way, as a game, where literally all that mattered was winning. Under his leadership, Bear built a massive, vertically integrated machine around subprime mortgages. They didn't just trade these risky assets, they bought the actual lenders, they packaged those toxic loans into complex CDOs, and then they sold them off. They made absolutely sure they profited at every single step, which meant they became deeply, inextricably entangled in toxic risk.
So flash forward to July 2007, and the first massive red flag drops. Two of Bear Stearns' hedge funds, which had bet incredibly heavily on subprime mortgages, using borrowed money, just completely collapsed. They hemorrhaged money, suspended redemptions, and went bankrupt, wiping out $1.8 billion for investors. It was the first real shot across the bow of the subprime mortgage crisis. But here's the kicker. Because the firm itself survived the initial hit, leadership, and honestly all of Wall Street, just dismissed it. Amazingly, they viewed it as a totally isolated incident rather than the glaring systemic warning that it actually was.
Let's move to Section 2 and see how this builds Wall Street's hidden heart and the mechanics of fragility.
You have to understand, investment banks don't fund themselves like your regular neighborhood bank. They don't have mom-and-pop savings deposits to rely on. Instead, they borrow cash every single day in what's called the repo market. Think of it as a giant, high-stakes pawn shop for Wall Street. Bear Stearns would hand over bundles of securities to an investor, get cash overnight to fund their operations for the next day, and then buy the securities back later with interest. It's a system that functions entirely on one invisible currency, trust. And as a leader, you must realize this. If your survival relies on daily trust, any loss of confidence means instant death.
Now, I need you to wrap your head around this staggering number. 33-1. That was Bear Stearns' leverage. That means for every single dollar of their own money, they had borrowed $33. Just think about the razor-thin margin for error there. At that insane leverage ratio, a mere 3% drop in the value of their assets would wipe out the entire firm. And as we all know, the housing market in 2008 dropped by a heck of a lot more than 3%.
And this brilliantly illustrates how leadership tried to hide that insane leverage. They employed a very clever accounting trick. Right before their quarterly financial reports were due, they would temporarily sell assets, book it as a real sale, to artificially lower their leverage ratio for the regulators, and then just quietly buy the assets back a few days later. The risk never actually left the building, but the numbers looked pretty on paper, completely masking the true fragility of the firm from the SEC, the auditors, and get this, even their own board of directors.
Section 3. The 72-hour death spiral, when trust evaporates. On Monday, Bear Stearns opened with $18 billion in cash. They honestly thought they were perfectly safe. But that very same day, the Federal Reserve announced a new emergency lending facility, and the broader market immediately took it as a warning that someone was drowning. By Wednesday, pure fear just took over. Prime brokerage clients and repo lenders began instantly severing ties. By Thursday night, Bear was begging for a bailout. And by Friday, the market entirely rejected a desperate Fed loan. Trust evaporated, and the firm literally died in real time.
The violent plunge in cash is just terrifying. $18 billion on Monday, down to just under $3 billion by Thursday evening, barely $2 billion by Friday. But what's truly horrifying here is the leadership disconnect. On Tuesday, the new CEO, Schwartz, actually went on CNBC to project confidence, telling the world they had plenty of cash to weather the storm. He was completely unaware that the vault was already draining out from under him while he was speaking.
So, by Thursday night, total panic sets in. Schwartz is making these desperate phone calls, interrupting the vacations and birthday dinners of key Wall Street figures. He called Jamie Dimon, the CEO of JP Chase, and told him flat out they needed $30 billion before Asia opened, or they would fail. Heavy hitters like Timothy Geithner and Henry Paulson were suddenly yanked into late-night crisis management just to prevent global contagion. And remember, during all of this frantic, world-ending panic, Jimmy Cayne was still away playing in his bridge tournament.
The result of that frantic weekend was one of the most brutal fire sales in corporate history. Forced into a corner by the Treasury and the Fed, Bear Stearns was sold to JP Chase. The initial offer? $2 a share. That is a 93% discount from Friday's closing price. 85 years of ruthless Wall Street history, 15,000 employees, and a $20 billion market cap, all sold off for absolute pocket change.
Section 4. The systemic illusion, and honestly, the real horror of this story. Because here is the most terrifying reality about the fall of Bear Stearns. It wasn't a criminal fraud. There were no fake bank accounts like Wirecard, or massive, complex accounting scams like Enron. Bear Stearns was simply doing what every other major bank was doing, just a lot faster and with way less of a safety net. The SEC monitored them, sure, but they accepted the accounting tricks. The auditors and the board signed off on everything. The entire system was fueled by incentives that rewarded massive risk and total opacity. It was a completely sanctioned system of fragility.
As Fed Governor Kevin Warsh noted at the time, the real danger wasn't just that Bear Stearns was falling, it was what their failure revealed about the broader system. Bear was just the canary in the coal mine. They were exposing a deeply flawed structure where the sheer complexity had completely outpaced everyone's understanding. And because the root issues weren't truly fixed after this, just 6 months later, Lehman Brothers collapsed in the exact same way, dragging the entire global economy down with it.
Section 5. Lessons for modern leaders. Let's look at the autopsy results.
So, the crucial point is this. For your own organization, remember that pretty metrics on a spreadsheet will not save you if the cash drains. Reality always catches up. Second, you absolutely must understand your own complex systems. If your operations are so opaque that even you don't grasp the real risks, ruin is hiding right there in the shadows. Also, if your business relies on daily trust, you need to recognize how incredibly fragile that is. Fear is contagious, and trust can vanish quite literally overnight. And finally, disconnected leadership is the ultimate vulnerability. You simply cannot govern what you refuse to look at.
Which brings us to our final thought. The real tragedy of Bear Stearns wasn't just that the market turned against them. It was that their culture blinded them to the danger, their systems masked the incredible risk, and their leadership completely checked out when it mattered most. So take a hard look at your own organization, your own risks, and ask yourself this haunting question. Are you actively engaged with the reality of your business, or are you playing bridge while your empire burns?